Hey everyone, I'm Ivana and welcome back to the channel where we talk about investing, building wealth, and making your money work for you. Today we're going to break down 10 investing terms every beginner should know. Things like ETFs, dividends, and even that mysterious P/E ratio. If you're just starting out or want to finally understand all the confusing stock market terms, this video is for you. Make sure to hit that like, subscribe, and let's get into it. First up, ETF, which stands for Exchange Traded Fund. An ETF is basically a basket of stocks or bonds that you can buy and sell on the stock market, just like a regular stock. Instead of buying just one company like Apple, you own a tiny piece of lots of companies at once. For example, VTI, VU, and SPIRE ETFs. They hold hundreds or thousands of stocks in one fund. This makes ETFs diversified, low cost, and easier for beginners to start investing. Next, an index fund. An index fund is a type of ETF or mutual fund that tracks a specific stock index, like the S&P 500. Instead of picking individual winners, you just follow the overall market or index. This is a favorite for long-term investors because it's simple, low cost, and historically reliable. Now, a dividend. A dividend is money a company pays to its shareholders, usually every quarter. Think of it like getting a small paycheck just for owning the stock. Dividend-paying companies are usually stable and profitable, and reinvesting those dividends can supercharge your returns over time. Now, market cap. Market cap is short for market capitalization. It's basically the total value of a company's stock. Market cap equals stock price x number of shares. Large cap equals big companies like Apple or Amazon. Mid cap equals growing companies like Spotify. Small cap equals newer companies with more growth potential but riskier. The P/E ratio, or price to earnings ratio, shows how expensive a stock is compared to its profits. Formula equals P/E equals stock price divided by earnings per share. Low P/E, stock might be undervalued. High P/E, investors expect growth in the future. It's one way to compare stocks in the same industry. A bull market is when the stock market is going up. Investors are confident. A bear market is when the market is going down. Investors are cautious or selling. Knowing this helps you stay calm during ups and downs instead of panicking. Diversification. Diversification means spreading your investments across different stocks. Why? So if one investment drops, your whole portfolio doesn't crash. Think of it like not putting all your eggs in one basket. Compound interest is when your money earns money on money. Here's an example. If you invest $100, earn 10%, now you have $110. Next year, 10% of 110 equals $11, which is $121 total. Over time, compounding can turn small investments into huge growth. Liquidity means how easy it is to buy or sell an investment. Stocks and ETFs are very liquid. You can sell anytime. Real estate or collectibles are less liquid, harder to convert to cash quickly. Finally, risk versus reward. High-risk investments equals potential for bigger returns but bigger losses. Low-risk investments equals smaller returns but safer. Every investor balances these depending on their age, goals, and tolerance. And there you have it, 10 investing terms explained in a simple way. If you're just starting out, these are the basics you need to understand before buying your first stock or ETF. If you found this helpful, hit that like button, subscribe, and comment below which term was new to you or which one you want me to explain deeper on in a future video. Thanks for listening.